Good morning from sunny and cool Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thank you for joining me for our latest Following the Money podcast. Today is Sunday, August 23rd, 2026. 2 weeks ago, we spent a lot of time talking about why we believe investors should trust a process rather than a prediction. Today, I want to show you why that matters in real time. Because during the past 2 weeks, investors have been hit with an extraordinary amount of conflicting information. We've had changing expectations for interest rates, rising long-term treasury yields, renewed concerns about inflation, another spike in oil prices, continued uncertainty surrounding tariffs and global trade, and an increasingly unpredictable situation between the United States and Iran. And through all of that stuff, the stock market has been trying to figure out what matters and what doesn't. That's exactly the kind of environment when we believe data and rules become especially valuable. The past 2 weeks, what the market is telling us. Since our previous Following the Money exactly 2 weeks ago, the big picture message from our research is that the U.S. stock market's primary trend remains positive, but the evidence underneath the surface of the market has become considerably more conflicted. The S&P 500 initially extended its early August breakout to new highs before retreating last week, while our work has simultaneously shown some significant deterioration in intermediate-term market factors, even as the shorter-term picture remains more constructive. Meanwhile, long-term treasury yields have risen to almost 20-year highs, and oil prices have moved sharply higher again as the breakdown of U.S.-Iran negotiations, seemingly for the 2000th time, have renewed inflation concerns, worries that inflation is going to move higher. At the same time, tariffs and unpredictable policy coming out of Washington continue to complicate the economic outlook, while investors are trying to determine how much pressure higher energy prices and borrowing costs will ultimately put on consumers and also on corporate profits. Perhaps most important, the rapid rotation we're seeing among the market sectors, asset classes, and also in global markets suggests that institutional investors themselves are struggling to handicap these constantly changing conditions. So our message remains: respect the primary uptrend, but don't confuse a rising S&P 500 with an absence of risk. This is precisely the kind of uncertain environment where following the data rather than the narrative becomes especially important. Let's start out by looking at keys to this week. There's two different market stories here. You can see the title, Bullish Trend Meets Defensive Institutional Positioning. I think this week's report is particularly interesting because we're essentially seeing two different stories depending on the time frame you're looking at. On the tactical side, as we scroll down, on the tactical side, on a monthly basis, our key near-term factors remain positive for the fifth consecutive week. You can see that here on our graphic. Most of the population, let's call them, of our 10 keys are up here to the upper left, which is tactical positive. Tactical for us is 21 business days. So we're really looking at 1 to several weeks. Specifically, the minor trend in the S&P remains up. Here's the chart showing that. Here's the March bottom. Here's the June peak. Here's that investor indecision in the middle that we've been talking about, which is what happens sometimes when the market goes up too fast and needs to kind of take a breath, and especially with all the mixed messaging coming out of Washington, it's exacerbated this. So we've broken out of that sideways area, and as long as we stay up above the upper boundary of that sideways area, let's call it investor indecision area, the trend is still good. Note that 76.21 is also where the 21-day moving average is. It's a monthly moving average, a tactical moving average. So our focus next week is going to be on 76.21. Next thing, investor assets continue to support higher prices. But even though this is positive, it's just barely positive. Note with the exception of just a couple of days in June and one day in July. April 7th is when the assets, the AUM in the S&P 500 has been expanding over its 21-day moving average, monthly expansion. It's positive for the market. Look what's happening, though, here. As of Thursday, and we don't have Friday's data yet. We're not going to get that probably till later today or maybe Monday morning. But we're sitting right on top of that line again. What does that mean? That means that new money needs to come in here early next week in order to keep the trend alive. If that doesn't happen, now going back up to our first chart, now the 76.21 area becomes more important because you don't have that horsepower coming in to bounce it off of that support. So that's really important to us going into next week. Another thing that we're looking at, stocks are outperforming bonds. When stocks outperform bonds, the market goes up. So here we're looking at SPY versus TLT. And TLT is the price of a 20-plus year Treasury bond. Note that on April 6th, stocks, aka SPY, started outperforming bonds, aka TLT, and did so until June the 5th. On June the 5th, we got this little pullback. It didn't last very long, but that was a period where stocks were underperforming bonds. Now, since July the 1st, we're outperforming again, and look where we are. We're sitting right on that 21-day moving average. So there's a lot going on here in these just 2 or 3 different charts. Tactically, it indicates the market's in good shape, but we need to see a new flush of interest coming into the market next week in order to maintain it. But once you move out to the strategic time frame or quarterly time frame, different picture. Our intermediate term indicators have now maintained a negative distribution for 2 consecutive weeks following a couple of weeks of neutral readings. Let's look at those. We're looking at charts 4, 5, and 6 now. Chart 4 is the NASDAQ 100. It's a market leader, traditional market leader on top. And down underneath, you have the NASDAQ versus the S&P 500 via a relative performance chart. Note that since July the 13th, NDX or large cap stocks are underperforming the S&P 500. That is typically not something that happens in a healthy bull market. Next, semiconductors. We look at the Philadelphia, or the PHLX Semiconductor Index up here by itself on top and relative to the S&P 500 down here at the bottom. Note that since July the 15th, semis also are underperforming the S&P 500. That typically does not happen during a healthy bull market. The third chart looks at it from the other way. SCHD is the Schwab US Dividend Equity ETF. So dividend stocks here versus growth stocks down at the bottom. When this outperforms, it indicates that the market is defensive. For those managers who need to be in the market all the time, at least with most of the money that they're managing, this is one vehicle that they can use to buy more defensive choices. So look what happened here. Since the beginning of the year until April the 10th, defensive stocks, dividend stocks were outperforming growth stocks. That's when the market was weak and making its bottom on March the 30th. Since then, from April 10th, they started underperforming. Why? Because the money was moving into those faster horses again, moving into semis, moving into big cap tech. Since July the 16th, though, we've got dividend stocks outperforming again. So even though the market on a tactical basis is holding on, underneath the surface of the market, it's getting weaker. And note that all this stuff happened around the middle of July. So if we roll back up here, here's the middle of July. Right in here, when the market was going sideways, that's when everything started to move on a relative performance basis to more defensive choices. So again, this is not a prediction that the market's going to decline. It's information. And our job is to respond to that information rather than trying to predict what comes next. let's move to the Asbury 6, which basically for us is looking under the hood of the market. So here's our Asbury 6 through the end of last week. This gives us, again, another look at the market from a different angle. For anyone new to following the money, Asbury 6 is our daily data-driven gauge of U.S. stock market's internal health. It combines 6 diverse metrics selected through quantitative backtesting to answer one simple question. Should investors currently be increasing or decreasing their exposure to equities? The Asbury 6 continues to maintain the positive bias that began on July the 31st, but just barely. Let's look at these components. We've got the rate of change here in the S&P 500, positive since August the 3rd. And look at all this activity from 727 to 731 in the relative performance of stocks versus high yield bonds in asset flows. We looked at those asset flows a couple of charts back, and they're hanging on by their fingernails. Volatility, trading volume, and market breadth, all from the 27th through the 31st. That's when the S&P bottomed and then had that crazy rally where it went 6% higher in four business days. So positive, and I don't have time to go through all those charts with you now. We talk more about that in our premium service, but basically this is reflecting what we saw in Keystone this week. If the market's still good, that 76.21 support level in the S&P 500 is very important next week. A rules-based process just doesn't simply tell us bullish or bearish and then allow us to stop paying attention. It tells us how strong the evidence is behind the conclusion. And right now, as I said, the Asbury 6 says the market's internal condition remains supportive, but we're close enough to the line of demarcation on all 6 of these indicators that we need to pay special attention now. And if those conditions change, and if they start to deteriorate, we should see that next week. If it's going to happen enough to change this signal, then we change along with the signal and we move to more defensive tactical approach. No debate, no ego, no rationalizing why the market must be wrong. We just follow the rules. We just follow the numbers. Sector rotation is going to be our next thing that we talk about, and it's telling us something important. So we're going to go to our CEF model, which is our sector rotation model, and we'll scroll down to the latest graphic. Another area where the market has been sending us a very interesting message is sector rotation. Our CEF model tracks asset flows and relative performance among the 11 sectors of the S&P 500. And since June, the movement of money between these sectors has been unusually erratic. The most erratic that I could remember seeing this. And the CEF model is somewhere close to 8 to 10 years old. So first of all, what's the CEF model? The CEF model measures the velocity of money moving around the 11 sector spiders, which together comprise the S&P 500, to see where the money is going in multiple time periods. And we have a ranking score. So right here, we're looking at the trading week. Healthcare up on top was the second strongest money in over the past trading week, which is this past week, of course. Tactical is the past month, the past 21 days, also number 2. Strategic, which is the quarter, it's number 1. So we've got a score of 5, and this is like golf. The lowest score is the best. So right now, our top 3 are healthcare, energy, and materials, XLV, XLE, and XLB. That's where the money is going. The money is coming from down here in the avoid status, which is the red. It's coming from technology and communication services. So you can see we're set up defensively here. I mean, we're in healthcare hard. We've got a very strong ranking of 5, and we're moving out of the faster sectors. Faster horses, so to speak, which is XLC and XLK. But keep in mind, this has been ping-ponging back and forth for the past 13 weeks while we hear the tariffs are on, the tariffs are off, the war is on, the war is off. These managers are scrambling around to try to get ahead of the next tweet, and there's been a lot of volatility here. Like I said, since June, the movement of money has been extremely erratic. We've seen these sectors rapidly move in and out of favor rather than establishing the kind of persistent leadership trends that we normally see most of the time, or certainly a lot of the time. We believe that's important. The market can handicap bad news. Markets deal with recessions, wars, inflation, and high interest rates all the time. They did a very good job of handicapping COVID not too many years ago. What markets have a much harder time dealing with is uncertainty. And the geopolitical uncertainty is as crazy as I've seen it. Right now, investors are being asked to continually reprice the economic implications of changing U.S. policy towards Iran and its effect on oil prices, changing tariff policy and its effect on global trade, the direction of interest rates, Federal Reserve independence, which has also been in the news lately, and the broader relationship between the U.S. and the rest of the world. When these inputs keep changing, the money keeps moving. CEF allows us to actually see that happening. Next thing we're going to look at is the CARP model. This is something we don't talk about a lot, but I think it's really significant now. So we're going to look at that. This is another part of the premium service, and this is CARP. Our CARP model. CARP is a acronym for cross-asset relative performance, compares different asset classes and market relationships to determine whether investors are generally embracing risk or if they're avoiding risk. This is another area where the evidence has become a little more complicated. Let's look at these relationships. So stocks are outperforming bonds. High beta stocks are outperforming low volatility. Large caps outperforming small. Broad market is outperforming blue chips. Value is outperforming growth. Developed markets are outperforming the U.S. market. So what we do is we look at this once a week in a snapshot, again, in 3 different time periods. And here's our investment implications right here. The latest CARP model update through August 24th depicts a market in transition with the strong risk-off, risk-on signals of recent weeks giving way to much more balanced and indecisive strategic environment. Let's skip ahead. Importantly, high beta versus low volatility, large cap versus small cap, and the broad market versus blue chips have moved essentially to neutral, suggesting that institutional investors currently lack a strong conviction either offensively or defensively. It represents a considerable improvement from CARP's clearly defensive alignment in mid to late July, but also a loss of momentum from the tentative market positive shift that we saw 1 week earlier. Meanwhile, the fixed income relationships remain unusually mixed, suggesting caution about interest rates and credit conditions without signaling an outright flight from risk. So would we like to have a more compelling setup here, that it's risk on or risk off for some definite conclusions? Yes, but again, we're not trying to sell a story to the media. We want to know what the condition of the market is. And the condition of the market right now is indecisive. The market doesn't know what to do here and is having a problem sorting through the information and coming up with a conclusion. We're seeing relationships among stocks, bonds, growth, value, government debt, corporate debt, and different bond maturities that are all not pointing in the same direction. It's not a flaw in the model. That's the message. Markets aren't always neatly risk on or risk off. Sometimes institutional money is saying, we're still willing to own stocks, but we're becoming increasingly concerned about what's going to happen next. This is the kind of nuance that disappears if all you're watching is whether the S&P 500 went up or down today. Our next one we're going to look at is another one that we don't look at frequently, but it's our U.S. versus the world model. And here it is. U.S. leadership fades as the world strengthens. As of Friday, 17 of the 25 global equity indexes in our U.S. versus the world model are now outperforming the S&P 500 on a strategic or a quarterly basis. That's 68% of the markets we track. Even more interesting, 16 of them, as I put this into a little better focus, 16 of these markets are outperforming the S&P in all 3 of our time frames, weekly, monthly, and quarterly. That's the green bowl that you're seeing all the way across. Think about what that means. Capital isn't simply clustering in one country or one region. We're seeing evidence of broadening global equity leadership outside the U.S. Again, we're not making an economic forecast and then trying to look for data to support that. We're observing where the money is going right now. That's the difference. Let's look at this summary very briefly. The latest U.S. versus the world model update through August 24th shows a dramatic resurgence in international equity leadership. 16 of these markets, 16 of the 25 are now outperforming the U.S. across multiple time periods. This represents a significant reversal from the previous 2 weeks. Because the current outperformers are distributed virtually across every geographic region, the shifts suggest improving global risk appetite and confidence in economic and earnings prospects outside the U.S. rather than just a region-specific rotation. Taken together, the model suggests institutional capital is not necessarily abandoning risk, but increasingly diversifying it away from concentrated U.S. leadership. That's the phrase that pays here. That's really important. That's really important to know that. Why we use multiple models. This brings me back to the individual philosophy we've been discussing throughout these podcasts. We don't have, we don't have one magic indicator. I get asked that question all the time. What's your favorite indicator? I don't have one. They're like tools in a carpenter's toolbox. They all do different jobs. The Asbury 6 measures internal health of the market. The CEF model measures where the money is moving around in the U.S. sectors. CARP looks at relative performance between domestic asset classes. U.S. versus the world measures global relative performance across 25 markets outside the U.S. And Keys to This Week brings these and other data together across different time horizons. We're deliberately looking at the market through different windows. When these independent data sets all start to say the same thing, our confidence increases. We become more secure in what we're doing. When they disagree, as some of them do right now, that disagreement itself becomes valuable information. It tells us uncertainty is elevated and that risk management becomes a lot more important. That means watching your downsides. We believe in defense first. The stock market inherently goes up most of the time. Different than the commodity markets that I started with on the floor of the Chicago Mercantile Exchange back in the 80s and 90s. Stocks go up most of the time. We don't believe successful investing is simply about generating the biggest return possible during a bull market. It's also about what you don't lose when the conditions turn against you. And the market does what it typically doesn't do very often, is go down. That's why our models focus heavily on maximum drawdown, volatility, beta, and risk-adjusted returns. Think about investing like a football game. A team doesn't play exactly the same way with a lead late in the fourth quarter as it does early in the first half. The objective hasn't changed. You're still trying to win the game. But when circumstances change, intelligent risk management means the way you play the game may need to change too. Investing should work the exact same way. The stock market has historically risen over time, so I don't believe you need to take excessive risk every day to build wealth. The secret to winning this is a quote from early in my days on the CME, when I was 24 years old and eager to learn everything about this cool new business that I got into when I was a runner on the floor. And one of the old timers came up to me and he goes, the secret to winning the game is staying in the game. And that's so true in these markets. Limiting your losses, especially as a lower investor. Everything I've shown you today ultimately feeds into the same philosophy that we use in our managed portfolios. Jack and I have created 5 different model portfolios built primarily around the CPM, the correction protection model, which we didn't get to this week, and our CEF, our sector rotation methodology, ranging from more conservative to more aggressive approaches, but built on these 2 cornerstone models of ours. These aren't models built around what we think the economy should do. They're designed to adapt to what financial markets are actually doing. And as I've said before, All of my own equity-related investment dollars are invested in these models. I truly believe in them. I think they're a great way to play the game with less risk. Doesn't mean they're always going to be right. They won't be. When the markets are jumping around like this, following the money is equally jumpy, equally erratic. But I want my own money managed by the same disciplined process that we're discussing with you. You can request more information about these models and more about what we do right here by clicking on research or managed accounts. Again, the point isn't to be right every day. If there's one thing I want you to remember from today's podcast, it's this. We don't need to predict the future to successfully navigate financial markets. We can change when the markets change. Forecasting is a parlor game for the suits on CNBC. I don't think forecasting, or it certainly isn't a part of what I do. I let the market tell me what it's doing, and then I follow it. Nobody knows precisely where the S&P 500 is going to be 6 months from now. So that game that we play, where's the market going to be at the end of the year? Again, it works for TV, but it doesn't really work for your bank account. Nobody knows exactly where interest rates are going to be. Nobody knows how the Iran situation is going to play out and where oil prices are going to go, or what the next change in tariff policy is going to be, especially the latter. What we can do, though, is measure how investors are responding to these things. We can measure trends. We can measure asset flows. We can measure relative performance. We can measure volatility. We can measure risk appetite. And then we build rules around that evidence. That's what following the money is. So that's it for today's Following the Money. The next one will be exactly 2 weeks from today, which will put us into September in football season, which is great for me anyway. Right now, the market is giving us a mixed but extremely interesting message. The tactical trend remains positive. The strategic backdrop has weakened. Our Asbury 6 remains positive, but is close to the line of demarcation where it could flip going back to negative next week. All 6 indicators are right at that point. Global equity leadership is broadening dramatically, and sector rotation continues to reflect an unusual high degree of investor uncertainty. But this week, our number one sector this week is healthcare. That's a defensive sector. So even though the market is still in a bullish trend, internals are starting to kind of play, go into the turtle a little bit, to use a boxing metaphor, starting to prepare for the worst. That's why these relative performance relationships are starting to change, as we saw a little bit earlier in the podcast. We don't know which of these forces is going to ultimately win. We don't have to. We'll let the data tell us. That's our process at Asbury Research. Data over opinions, rules over emotions, risk management over predictions, and above all, follow the money. If you'd like to learn more about Asbury Research, our research subscriptions, our managed account solutions, visit asburyresearch.com. It's on your screen right now, and use the contact tab up at the top, the contact button up at the top, to get in touch with us. If you found today's discussion useful, please like this video, subscribe to the Asbury Research YouTube channel, and share it with another investor who might benefit from a more disciplined, calmer, data-driven approach to investing. I'm John Kosar. Thanks for spending part of your Sunday with me. I appreciate that. I'll see you again right here in 2 weeks. Enjoy your Sunday and keep following the money.